Hey folks, this is Mark Weissy from Maple Capital Partners, and this is now July 2023 when we're putting this out, and we're going to go ahead and summarize some of what we learned from the most recent Apartments.com webinars and data releases. We find that the Apartments.com releases in terms of multifamily research tend to be really chock full of information and really timely data. Now, Apartments.com is owned by CoStar, which is one of the leading providers of multifamily data and research. And they also own LoopNet, which is a huge listing service, an aggregator for a lot of multifamily offerings in the market. So we find their data to be particularly insightful in terms of the trends that are going on and also their outlook going forward. So we're going to go ahead and break down some of the big takeaways that we had from their most recent releases. So without further ado, let's get started. So one of the first things that they broke down was supply. And this is a big one. In multifamily, generally, we're always talking about demand. What are the things that are driving different markets that we're looking at? Is it jobs? Is it population growth? But what gets overlooked a lot of times is what's going on the supply side. And right now, one of the topics du jour in multifamily is just the number of units that are coming online. And a lot of these units are currently under construction. This chart kind of summarizes where we stand versus historical production. And you could see here we're at a high going back to the 1980s, really, was the last time that we built this many multifamily units, which obviously that all has to get digested. And if supply is overreaching and there's not enough demand to keep up with that, then the market is in for rocky sledding here. So now looking at the deliveries, so that's not just the construction that's going on, but these are the actual units that are coming online. Again, that's also hitting a high that we haven't seen since the 80s. These are national numbers. We're going to go ahead and look at the Apartments.com data related to regions. So that's region-specific units coming online. We can see the deliveries in the Sun Belt in particular are among the highest and have been for the last few years. Now, that's probably not a surprise for anybody who's been following the market. The Sun Belt has experienced just rapid growth in terms of population. People coming in from all other parts of the country to live there. The climate, the low cost of living, relatively lower taxes. But that has to be, kind of weighed against the fact that there are so many units coming online. So again, Sun Belt is by far and away the highest in terms of deliveries of new units. Now we're going to go ahead and take a look at demand. So that's the other side of the technical picture in terms of multifamily. And also speaking of Sun Belt, they regained their top position in terms of demand. So we had runaway demand in 19, 20, 21, 22. The Sun Belt took a little bit of a breather. And then in 23, again, the demand in that region seemed to surge there. Notably, most part, the other regions stayed in line with where they were historically. 21 was a little bit of a blip. For the most part, deliveries have remained a little bit subdued in some of those other regions. Now, what effect has that had on rent growth? So we talked about supply, we talked a little bit about demand. Now, on the rent growth side, that's kind of where you marry the two, right? Because if you have a ton of supply and not a lot of demand growth, then you're probably going to see negative rent growth. That's been the case now. We're seeing that actually in some of the Sun Belt markets, which we'll touch upon in the next slides. But you can see that here, where post-COVID and even during the COVID epidemic, we saw some of the markets where rent expanded the highest or fastest were in the Sun Belt. So a lot of the markets that we're going to touch upon in the next slide, in some cases double-digit, 20+% increases in rent growth. Whereas today, it was some of the sleepier markets, some of the markets in the Midwest and the Northeast that are actually experiencing the fastest rent growth. You can see that there in this chart, indicated by the blue and green lines here. So now let's dial into specific markets. And this kind of nails home what I was just talking about. Some of the areas that are highlighted here, some of those cities, a lot of them actually are in the Southeast. So you've got the Atlantas, DFWs, Orlandos, Phoenix, that's a West market, but Charlotte, Austin, some of these markets were some of the fastest growing markets during the pandemic, and now are actually starting to see negative rent growth, starting to see rents decline here. Whereas if you look at some of the top leading markets in terms of rent growth, a lot of those markets show up in the Midwest and Northeast. Some of those areas that, again, didn't grow all that fast during the pandemic. So what you're seeing is a little bit of in the financial world, we call it a reversion to the mean. Basically, over time, all things kind of come back to the average. And so we're seeing a little bit of that in action here. But so this 2023 rents, it seems to be dominated by the Midwest markets again. Now, this is just bringing together everything we just talked about. While demand in the Sun Belt is outstripping, basically every other area, every other region of the U.S., that is dwarfed by the amount of supply coming online. And absorption rates, we're going to go ahead and take a look at that. That has basically remained stagnant. It hasn't over the last 6 quarters. It's really failed to eclipse 100,000 units. Now, absorption is a rate basically that is supposed to kind of weigh both the supply and the demand. It's basically the number of new units that are being rented by renters, and is a pretty good metric in terms of the technicals in a given market. And we can see here it's pretty much stagnant, so not a good sign on a national standpoint. That's also resulting in vacancy rates that are fastly expanding, specifically in again the Sun Belt market that contracted so sharply during the pandemic. And again, following the same trend we saw a couple slides ago, the Midwest, Northeast, and even the West are seeing their vacancy rates expand, although at a lower clip there. Now, looking forward, some positives about the multifamily market are, while we have a bunch of units coming under construction and being delivered to the market, it does look like with the interest rates and the hikes that have been in place now over the last year or so, Fed's been rapidly increasing the federal funds rate, we are starting to see that have an impact in terms of squeezing developers and really forcing developers to pull back on their permits of multifamily development projects. So we're going to see that play out over the next couple of years because, of course, many of these development projects take 1 to 2 years to actually come online. So that could bode well, let's say 2024, 2025, when a lot of the permits that, if we were staying to this trend, would have been pulled today, would have resulted in units then. That will not be taking place. So we see that sharp pullback here this year. And that's also kind of cemented or they also agreed with by some of the apartments.com data. They are saying the very same thing, that 2025 could give multifamily the supply pause it needs in terms of new builds. So while it may get a little bit rocky in the times coming ahead, and I know we've talked about this in previous videos where we've talked about a lot of the bridge debt coming due in the next 6 to 12 months, and a lot of the operators and multifamily investors in our space may be coming under a little bit of pressure there. We think that could offer a little bit of opportunity in the near term, where you could potentially pick up some multifamily, whether it be a new build or a B or C class, like the types of properties that we tend to buy. And if you're able to hold it for the next 1 to 2 years, there could be a little bit of a reprieve from all the supply glut that we're seeing over the last 12 months or so. So we think that fundamentally the long-term picture for multifamily hasn't changed, while we are facing a little bit of a supply headwind in the markets in which we invest, predominantly in the Midwest, although we are looking increasingly more at some of these Southeast markets. A lot of those markets are still exhibiting pretty strong absorption rates. And that's something that we will continue to monitor as we go forward. For us as multifamily investors, we're always thinking long-term. We're always thinking about, okay, we're going to hold these 5, 6, 7, 10 plus years to create that generational wealth and really, unlock the power of compounding in multifamily. So as a result of that, we believe that there's still a real need for affordable housing in this country. We are still not building enough of housing supply for that middle income renter who has gotten squeezed in almost unprecedented way in the last couple of years here by rising costs of living and rising interest rates that have basically barred them from ever owning a home. So we think that the long-term picture is still intact for multifamily. The short term could be a little bit rocky, but we'll keep our eyes open for opportunities. We hope you will too. So with that, we'll sign off as we always do. Capital Partners, be kind, be charitable, and invest wisely, folks. Thanks.